Well, welcome once again. Looking at the third component of our Introduction to Accounting today. So we've accomplished and completed tasks 1 and 2 of the required. So we can move on to the next 4 requirements actually, and in particular we'll start with requirement 3. Requirement 3 was to record the journal entries, including the adjusting entries in key accounts for November and December. Now remember, you've already completed October, so you should be quite familiar with this particular task. We're also told to assume that Lakeview pays income taxes, again, at a rate of 20%, and also to assume that this 2% dividend will be declared. So let's start. Going back to your question for November now, on November 1st, we're told that Lakeview signed a note to borrow $20,000 from CHIC Bank with an annual interest rate of 9%. Lakeview agreed to make a monthly interest payment on the 5th of each month, and the principal is due in 3 years. So they agreed to borrow $20,000 in this long-term note, and they've also agreed that in 3 years they will repay it in full, and during 3 years they will be paying 9% back on a monthly basis on the 5th of each month. So in order to record that we've received $20,000 cash in our asset account, our green account, we're going to post $20,000. Long-term notes payable is a liability account, and we will make a credit posting to long-term notes payable for $20,000 to record that liability. Now on November 5th, Ms. Lee paid the utility bill, the advertising bill, and the amount owing from the purchase of the fitness equipment. So if you remember, we had advertising and utility that we recorded in October, and we had recorded $1,150 in accounts payable. So we're going to be debiting accounts payable for $1,150 to clear that balance from our accounts payable account. So we'll make a debit entry to accounts payable to show the decreasing of the account, and we will also decrease cash, our cash asset account, by $1,150 to indicate the cash account balance has declined by that amount. If you recall back to the purchase of the fitness equipment, part of it was paid, $5,000 was left outstanding. So in accounts payable, in that opening balance of $10,650, that $5,000 amount is also included there. So we're going to reduce our accounts payable account balance by debiting $5,000 to accounts payable. And again, once again, we will reduce our cash account balance by $5,000 by crediting the account by that amount. On November 15th, Ms. Lee sold fitness lesson packages at $600 each to 8 customers. Each package has 20 lessons and is good for 6 months. 2 customers paid only $300 each, so they paid for half of the package and agreed to pay the remaining amount on December 15th. So what do we record here? On November 15th, we have received, how much in cash? We've received 8 lessons, of which 2 folks have only paid for half, so 7 times $600, or 6 times $600 plus 2 times $300. That gives us $4,200 in cash. So we'll debit our cash account balance by $4,200. We're also going to record in another asset account that we have a receivable that's due, and that's the 2 packages that have been only half paid, $300 each. So we're going to record an accounts receivable of $600, and we will debit that account to increase the account balance. And in unearned revenue, we're going to record $4,800, and that's for all of the packages that have been sold. Now, unearned revenue is a red account. It's a liability account. It's something that we must satisfy in the future. So we're going to be providing services in exchange for those funds. But right now we haven't provided any services. So it's a liability at the moment to us. Now on November 25th, Lakeview received again some more invoices, some more bills. Utility bill for $550 and an advertising bill for $1,100. And these are both due on December 7th. So we're going to add to our utilities expense account, or T account, $550. In the advertising expense account, we will make another debit for $1,100. In both these cases, we're increasing the expense account balances. And in accounts payable, we're going to recognize that we have a liability of $550 plus $1,100, or $1,650, that needs to be satisfied in the future. On November 30th, initially, the cash records showed that estheticians had provided facial, massage, and manicure services of $3,800 November, and hairdressers of $2,700. So these are cash records. So this indicates that all of the cash has been received. So $3,800 plus $2,700 is $6,500. So we're going to increase our cash account balance by $6,500. We will debit the cash account balance by $65. We're also going to recognize the revenue for body care and hair service by crediting body care $3,800 and hair service $2,700. Also on November 30th, Ms. Lee paid $2,200 to the estheticians and hairdressers for the work that they completed in the month of November. So this $2,200 has actually been paid. So we must reduce our cash account balance by crediting the cash account by $2,200. And we're going to recognize that salary expense has to be posted debit entry to salaries expense $2,200. Moving on to December now. On December 5th, Ms. Lee made the interest payment for November, and she also paid the utility bill and the advertising bill. So let's look at the interest expense first. And notice that the interest expense is going to be debited for $150. So how did I come up with $150? Well, the interest payment for November that's being recorded arises from the $20,000, that long-term note. We'll record an interest expense in the amount of $20,000 times 9% divided by 12 months. This is a monthly expense that we're recording, and that comes to $150. So we'll debit interest expense by $150. And she's actually paying $150 this month, so we will credit cash and reduce our bank account balance by $150. She's also at the same time paying for the utility and the advertising bills for November. So we will debit accounts payable and reduce the carrying value of that liability account by $1,650. And we'll also reduce our cash account by $1,650 and bring that balance to recognize that the cash has gone out. On December 20th, Ms. Lee sold 20 Day Spa gift certificates for $150 each and 5 mini fitness passes for $100. And these were all made for cash. They were holiday promotional items which would expire in 2 months. So what we are going to do is recognize that we've received some money. She's received $3,000 gift certificates. 20 times 150 is $3,000. And she's also received $500 or 5 times $100 for the mini fitness passes, for a total receipt of $3,500. So we'll debit our cash account by $3,500. And once again, these are gift certificates and passes. It recognizes, we recognize that this revenue has not been earned yet. They've just got passes or certificates. So we have to make a posting to recognize the liability to unearned revenue, and we'll post a $3,500, a credit posting to recognize the increase in this liability by $3,500. Now on December 15th, Ms. Lee received a check for $300 from one of the clients who had purchased a fitness lesson on November 15th. So they're actually paying what they owe. So we're going to debit our cash account by $300, and we will credit our accounts receivable and bring that asset account down by $300. So in essence, we're exchanging one asset for another for the amount of $300. Now on December 24th, Ms. Lee found that the record showed that estheticians had provided facial, massage, and manicure services of $3,600, of which only half was on account for December. So she only received half in cash and half was receivable. And hairdresser service of $2,400, of which a quarter was on account, and I guess 3/4 would have been recognized and received in cash. In addition, she found that 40 of the regular fitness lessons were delivered, and 6 of the gift certificates were redeemed by customers. So we've got quite a few things to recognize here. So for the revenue accounts, let's have a look. For body care, we have to recognize the $3,600, so we will credit revenue body care by $36. She also earned $2,400 for hair services, so we will credit hair service for $24. Increase both of those accounts. We also have to recognize that all the money was received. She received half of $3,600, so that's $1,800, and she received 3/4 of the $2,400, so that means that $600 is still outstanding, still receivable. So $1,800 and $600 gives us $2,400. So we'll make that posting to accounts receivable. We will debit accounts receivable by $2,400. And we will credit cash for the $1,800 plus the 3/4 of $2,400, which makes $3,600. We also have to recognize the second component of the transactions that happened on December 24th. We have 40 regular fitness lessons that were delivered and 6 gift certificates that were redeemed by customers. So we're going to be doing a few things. We're going to be recognizing that some of the income that has been posted as unearned is now been earned. So in unearned revenue, we're going to recognize $1,200 through fitness, because 40 of the fitness lessons have been delivered. So we'll recognize $1,200 in fitness, and that's a credit entry. In unearned revenue, we will post a debt, the carrying value of that liability by $1,200. We're also told that 6 of the gift certificates were redeemed by customers. 6 times 150 is 900, so we'll reduce unearned revenue by 900, and we'll increase the balance in our body care revenue account by posting a credit to revenue body care of $900. Also on December 24th, Ms. Lee made a note that the salary for estheticians, hairdressers, and fitness instructors amounted to $3,100. She would pay their salary on January 2nd, and the company is going to be closed for Christmas and New Year holidays. So we need to recognize the salary expense. So $3,100 will be debited to salary expense, and since it's not going to be paid till later, it'll be paid on January 2nd, well, the credit cash this time is going to be a credit to salary payable to recognize that there's a liability that needs to be satisfied in the future. So we've completed recording all of the entries in our T account for November and for December. And now we should consider whether there's any adjusting entries that are required. So the requirement for task 3 was to record the journal entries, including adjusting entries in the T accounts for November and December. We're also, if you remember, we were told to consider that Lakeview will pay income taxes at 20%, and that this 2% dividend is going to be declared. So let's go right back to the beginning of the question and let's scan through all of the transactions and all of the things that have been summarized for us and see if we need to adjust for anything. So one of the things that we're told about on October 1st was that Miss Lee opened a bank account for the business and deposited all of the money in the account, and that she rented a location on a waterfront mall for $1,500 a month, and she paid 3 months rent, 3 months worth of rent, as well as the last month's rent deposit. So at the end of December, the rent for October, November, and December should be recognized. We all only recognized October when we made our recording of the prepaid rent and the expending of the $6,000 cash when she paid for those 4 months. So now we need to make sure that we have all of the 3 months recorded in rent expense. Because if you recall, we only have the 1 month. So under rent expense, we have to increase rent expense by $3,000 times $1,500. So we'll debit rent expense by $3,000. And we have to reduce the prepaid rent by the same amount. So we'll credit prepaid rent by $3,000. So we're only left with that 1 month. The last month's rent deposit is still going to be on the books. Everything else has been recognized as expensed and used up. Scrolling down now, remember on October 2nd, Miss Lee bought all of that equipment, and we decided that we would take care of the amortization, often called depreciation, at a later date. Well, let's recap what we had. Miss Lee estimated the computer would last 3 years with no residual value. The computer cost $2,400, and we're going to be recognizing the amortization expense over each month, and we had 36 months, 3 years times 12 months, 36 months, and we've actually used up October, November, and December, so 3 months. So $2,400 divided by 36 times the 3 months that have passed is equal to $200. So under computer equipment, accumulated amortization, remember that's our contra account to computer equipment, we're going to record a credit to recognize the decrease in value and decrease in carrying value of our computer equipment, $200 credit entry. To recognize the expense of the amortization of the equipment, we're going to record a debit to amortization expense computer equipment. So taking care of the computer equipment, what do we do for the hairdressing furniture and fixtures? We're told that those assets would last 5 years and that there would be a residual value after 5 years of $300. So Miss Lee expects that in 5 years' time, all of that equipment will be worth $300. So she paid $4,500, or will pay $4,500, minus the $300 residual value. So we have to amortize or depreciate $4,200 over 5 years. 5 times 12 months is 60 months, and we've used up 3 months. So $4,500 minus 3 is $4,200 divided by 60 months times 3 months is equal to 210. So once again, we will apply the 210 with a credit entry to our contra account, accumulated amortization, furniture and fixtures. We will also record a debit of $210 to amortization expense, furniture and fixtures. Finally, the fitness equipment that she spent $8,600 on, we will take $8,600 and reduce that amount by the $200 residual value. So we're going to amortize $8,400 over the next 7 years. 7 times 12 is 84 months. So $8,400 divided by 84 months times 3 months is equal to $300. So we've used up $100 per month of that fitness equipment. So we will make a posting, a credit posting of $300 to the contra account, accumulated amortization, fitness equipment, $300, and the offsetting entry will be to debit our expense account, amortization expense, fitness equipment, by $300. Also, another item, on October 28th, Miss Lee had purchased that 1-year insurance policy for $2,400, and the coverage started in November. So how many months have gone by? We said it's a full year contract. It's for 12 months. We have November and December that have both gone by. We're at the end of December now. So $2,400 divided by 12 months times 2 months is equal to $400. So we have to recognize an expense for those 2 months of $400, and we'll debit our insurance expense, $400, and we will reduce the carrying value of our prepaid insurance by crediting that account, that asset account, by $400. Now on November 1st, Lakeview signed a note to borrow the $20,000 from CHIC Bank with an annual interest rate of 9%. They also agreed to monthly interest payments on the 5th of each month and the principal due in 3 years. So once again, we need to record an interest expense. We recorded the November interest expense, and now we have to record the December interest expense. So we're going to post to interest expense $150 by debiting the interest expense account, and we will also record that we have a liability to pay in January, the interest component, and we will credit interest payable by $150. So we've reviewed all of the transactions and made all of the adjusting entries that relate to those transactions. Remaining to complete are the entries to record the taxes and the dividends. So let's assume that a 2% dividend will be declared. We know that the share capital account shows that share capital has been purchased or acquired for $60,000. That's the carrying value of the share capital. So we will post 2% of $60,000, $1,200 to dividends. The dividend distribution is 2% of $60,000. So we'll make a debit entry to our dividend account, and you see that that is also a purple account. It's part of our equity account, and it represents the reduction in what's owned and what's retained by the shareholders. And that reduces our retained earnings eventually. It'll be closed off to retained earnings. Now, we've declared this dividend, but we haven't paid for it, so we must recognize the liability, and we'll post the liability of $1,200 by recording a credit entry to dividends payable. In order to complete the calculation for our taxes, we should sum up all of our T account balances and carry over the amounts to our adjusted trial balance. Only once that's been done will we be able to calculate the appropriate amount for our income taxes. So we sum up our cash account balance, and as you can see, we sum up $87,700 on the debit side for our months of November and December, and $10,150 for those months on the credit side. The difference between the two is $77,550. It's an asset account balance. It's a positive amount. It's the debit balance, left-hand side. For accounts receivable, the transactions summed up for the months of November and December tally up to $3,300. The difference between the debit balance of $3,000 and $300 credit balance gives us the summary amount debit for accounts receivable, $2,700. For prepaid insurance, we had a total of $2,400 on the debit side and $400 on the credit side. And the difference between the two leaves us a debit balance of $2,000. With prepaid rent, if you recall, we cleared $3,000 from the balance, leaving $1,500. And those are some of our asset accounts. If you remember, we still have all of the furniture and equipment asset accounts, so let's see what's been impacted on those key accounts. For computer equipment, we have $2,400, and if you remember, we posted that posting to accumulated amortization computer equipment, $200. So we reduced the net carrying value of our computer equipment down to $2,200. For furniture and fixtures, there were no further purchases, so we're still left at $4,500, but we've also recognized accumulated amortization of $210. Basically, that account balance down to $4,290 net. For the fitness equipment, no change to the carrying value of our assets, with the exception that we posted the $300 to accumulated amortization of fitness equipment, bringing the net value down to $8,300. That completes our assets. Let's move on to our liabilities. With accounts payable, if we sum up transactions for November and December, we have $7,800 on the debit side, and we have $12,300 on the credit side, leaving us a credit balance of $4,500. Salary payable, we just have a credit balance of $3,100. Unearned revenue, there were several transactions to unearned revenue. On the debit side, summing up, we have $2,100, and on the credit side, we have $8,300. The difference between the two is a credit balance of $6,200. Interest payable, we just have that one posting of $150. Income taxes payable, that's yet to be determined. Dividends payable, we have $1,200, and the long-term note payable, no change at $20,000. In our shareholders' equity section, our share capital is unchanged with the balance of $60,000, and our dividends, we did declare dividends, we have a debit posting of $1,200. With regards to our revenue account, our three revenue accounts, summing up the transactions for all of the month, we have a closing balance of $7,700. Closing up our body care revenue, we recognize that we have a credit balance of $11,400. And for fitness, if you recall, we recognized $1,200. We still have several expense accounts to review. For utilities, we have a total of $950. Advertising, $1,850. Insurance, $400. Interest expense, $300. Rent, over the 3 months, total $4,500. Salaries total $7,100. We also have the amortization expense for computers, furniture and fixtures, and fitness, and those are respectively $200, $210, and $300. Finally, our income tax expense we have yet to determine. So now that we've totaled all of our key accounts, we'll carry over those balances for just the trial balance. And once the figures have been carried over, we can easily sum up our revenue and expenses and determine our income tax expense and payable, and then make the posting to those key accounts. So carrying over all of your balances from the key accounts, as you can see, we're going to post those to our adjusted trial balance, and we will make all of the postings to our green asset accounts, our red liability accounts, keeping our debits and credits on the right side. We will also post our shareholders' equity account, the share capital, and the dividend postings. In the second half here, we have our revenue account, which of course will be on the credit side, and our debits all to our expense accounts. And once you've summed that up, we see that we have a difference of $4,590, and 20% of $4,590, the difference between our revenues and our expenses, $918 needs to be recognized for interest expense for the entire period. So we're going to recognize the income tax expense and make the posting to the key account, and then carry those amounts over to income taxes payable and income tax expense. So to recap, we sum up our revenues, and our revenues tally up to $20,400, and the sum of our expenses is $15,810. So the net income before taxes will be $4,590, and our income tax expense will be $4,590 times 20%, or $918. Now, we haven't paid the income taxes yet, but we will record the expense by debiting income tax expense, $918. We will also record the liability. We have to pay our income taxes payable by crediting income tax payable, $918. And those amounts will be carried over to our adjusted trial balance. So we've completed our T account. We're going to carry over our income taxes payable and our income tax expense to complete our adjusted trial balance. And that completes our fourth problem requirement to prepare the adjusted trial balance on December 31st, 2009 by using the worksheet. So continuing from our adjusted trial balance, the only thing that was lacking in the figures that we had inputted previously was the $918 that we're going to post, and that you're posting now, the income tax payable, and the $918 that you record to income tax expense. And we sum up both sides, both the debit and credit sides, to make sure that everything balances. And you should have a total of $117,178 on both sides. So what are we going to do now? Now we'll look at the requirement 5. Using our completed adjusted trial balance, we're now going to be able to complete this fifth task. Prepare the income statement and the statement of retained earnings for the first 3 months of operation and the balance sheet on December 31st, 2009. So going back to our blank form, we're going to prepare an income statement. We'll put a title, Lake Limited Income Statement, and it's going to cover the 3 months ended December 31st, 2009. And we will record first our revenues. Those blue accounts will bring our totals down from our adjusted trial balance, and we bring in $7,700 for hair services, $11,500 for body care. For fitness, we carry over $1,200 for a total of $20,400. We bring over all of our operating expenses, advertising, rent, salary, utilities, all of our amortization expenses, sum those up, and we get $15,510. Our operating income is $4,890. Our interest expense, which is not a component of operating expense, is $300. So subtract $300 from the $4,890, and we have income before income tax of $4,590. Subtract out our income tax expense of $918, and we have net income showing in blue of $3,672. Once again, we're going to calculate that EPS. We're still at 6,000 shares outstanding, and we're going to take our $3,672 net income and divide it by the $6,000 shares, and that will give us EPS of 0.6120. We're also going to prepare something called the Statement of Retained Earnings, and it shows how much has been retained in the business at the end of the cycle. Our opening balance for retained earnings on October 1st was zero. There was no balance. The company just started. So our opening balance is zero. To the opening balance, we add net income and we subtract our dividends. So we're going to add net income of $3,672 to that zero balance. Gives us a subtotal of $3,672, from which we subtract the dividends of $1,200. Our closing balance retained earnings, what's being kept in the company, $2,472 will be kept in the company. Finally, we need to complete something called a balance sheet. We saw a little bit of this in the first component of our webcast. We're going to put the title down, Lakeview Spa Limited, title of the Financial statement is a balance sheet, and we said that it's at a particular point in time. It's a snapshot of the organization as of December 31st, 2009. In our assets, we have current assets and non-current assets. The current assets are those that are going to be used within the next operating period, the next 12 months. We have cash, accounts receivable, prepaid insurance, and prepaid rent. All of the amounts from your adjusted trial balance for those four accounts will be carried over, and our total current assets are $83,750. We also have some non-current assets. We have computer equipment, furniture and fixtures, and fitness equipment. All of those items will be around for several years, so they're non-current. So we carry over the amounts from the asset account along with the contra account and calculate the net balance for our computer equipment, our furniture and fixtures, and our fitness equipment. And that totals for our non-current assets $14,790. So we sum up our current assets and our non-current assets and our total assets showing on the balance sheet, $98,540. And if you remember from the accounting formula, our assets should equal our liabilities and owner's equity. So let's see what happens on the other side of the balance sheet. Current liabilities, once again, categorize our liabilities in current and non-current. Current liabilities will carry over the account balances from our adjusted trial balance for accounts payable, salary payable, unearned revenue, interest payable, income tax payable, and dividends payable. These are all things that will be satisfied within the next operating cycle, the next 12 months, and the total current liabilities sum up to $16,068. We only have one long-term liability, and that's the $20,000 note, 3-year note payable of $20,000. So summing up our current liabilities and our long-term liabilities, we have total liabilities of $36,068. Final section of our balance sheet is the shareholder's equity, the owner's equity. So what do the owners have? Residual. Share capital is in at $60,000, and the retained earnings, we calculated and we prepared a statement of retained earnings and proved that the balance was $2,472. Total shareholders' equity then is the sum of those two, gives us $62,472. And if we add up our liabilities and our shareholders' equity, we have a total of $98,540. And that proves that our assets equal our liabilities and shareholders' equity. So everything is in balance. And that would be the completed presentation of our entire balance sheet. Haven't finished yet, but you're close to it. Our final task is to complete the Requirement 6. And Requirement 6 asks us to prepare the closing entries in the General Journal and the post-closing trial balance in the worksheet. So in this step, we're going to close out all of those temporary accounts to our permanent account by taking our balances from our T account or from our adjusted trial balance. We then complete a post-closing trial balance that should show changes to retained earnings and to our temporary accounts. Remember, we said we need to zero those out at the end of the period. So what does this look like? Getting your General Journal sheets out, we're going to start cleaning up our revenue accounts to retained earnings. So the date we're preparing this would be effective December 31st, 2009, and we're going to close out all 3 revenue accounts, care service, body care, and fitness. And we take the totals from either the T account or from your adjusted trial balance, and we will make a debit entry of $7,700, $11,500, and $1,200 to our revenue account. Remember, they have a natural credit balance. The totals are as shown in front, and by debiting those accounts for the total amount, we zero the account balances. And the sum of those three accounts will be posted to retained earnings, and retained earnings has a natural credit side, so we're going to increase retained earnings by $20,400. We have to do the same thing with the expense accounts. So we're going to be debiting retained earnings and crediting to clear out our expense accounts. So we'll be crediting advertising, interest, insurance, rent, salary, utilities, the 3 amortization expense for our capital assets, and our income tax expense. We will be crediting all of those accounts for the T account balance or the adjusted trial account balances. They have a natural debit side balance. We're going to credit them for the total amount to zero out all of these accounts. And that sums up to a posting to retained earnings of a debit of $16,728. Now that we've cleared out our revenue and our expense account, let's see what else we have to do. We have to close out the dividends. Remember, the dividends are going to be distributed. We've declared them. It's a distribution of earnings to the shareholders. Well, that $1,200, if you remember from the statement of retained earnings, is also cleared out to retained earnings. So the dividends were entered originally as a debit entry to the account, and in order to clear the dividends to zero, we will credit dividends by $1,200 to zero the account balance. And the offsetting entry will be a debit of $1,200 to retained earnings. So once you've posted all of the closures to your T accounts, you can now carry over all of the amounts to your post-closing trial balance to make sure that everything has been zeroed out. So we will carry over, once again, all of the amounts from our permanent accounts, our cash, accounts receivable, and all of the other asset accounts. Bring over all of the account balances from our liability account, share capital, and you can see now that we have an account balance that has been moved into retained earnings. Previously, retained earnings had a zero balance. There was nothing being retained in the company. Now we have $2,472. And moving down to the second half of our post-closing trial balance, we have cleared and zeroed out all of the revenue accounts and all of the expense accounts. So they all have zero balances. Once again, to ensure that everything tallies and everything balances, you'll sum up your debits and you'll sum up your credits to make sure that they equal each other. And in this case, you should have $99,250 on each side. And your entire set of trial balances should look just as I'm showing you here, with the 3 trial balances side by side, account titles, and the account numbers. So that completes all of the 6 requirements, all of the 6 tasks. You've learned an extraordinarily great amount of things today. So I'm hoping that you will have stopped at each component of the webcast and checked your learning. So let's check our learning for the entire course and see if you can answer some of the following questions. So, what are the 5 types of accounts and define the 5 accounts? Well, if we look back to our 5th PowerPoint slide, we said that the 5 accounts are assets, liabilities, equity, income, and expenses. And you can go back and have a check and see if your definition of each account matches or comes close to the definitions that are presented. We also went through and looked at the definition of the accounting equation. If you recall, in slide 8, we looked at when we're introduced to our T account, and on the top of slide 8, we're shown that our assets are equal to liabilities plus shareholders' equity. And we've actually seen on our balance sheet that that is the case. Our assets summed up and equal our liabilities and shareholders' equity. 3. What are the 3 main accounting principles guiding the accounting cycle process? Well, if we look on slide 6, we said there are 3 golden rules of accounting. We have personal accounts, real accounts, and nominal accounts. Double entry accounting system. Once again, if we look at slide 7, you may have forgotten a lot of these things. We've looked at so much today. We said that the double entry accounting system means that every transaction affects 2 accounts, the receiving side and the giving side. And it will be the receiving side and giving side of personal, real, and nominal accounts. Number 5 asks us to explain the rules of debit and credit. And we looked at the rules of debit and credit also on slide 5. And we said there were 2 rules for debits and credits. One is that we debit the left-hand side and credit the right. And the second rule was that our debits need to total our credits. What accounts use the debit side to record an increase in the accounts? We said that when it comes to looking at an increase or a decrease to accounts, looking at slide 9, remember that we said ADE, assets, debit, expenses, and liabilities, credit, revenue, which means that our assets and expenses would be increased by debiting, and our liabilities and revenue would be increased by crediting. That answers both questions 6 and 7. 8. What are the journal, ledger, and trial balance, and explain the purpose of each? And what did we say we use the journal, ledger, and trial balance for? Well, the journal, we record chronologically a record of our transactions, and it's also called the Book of Original Entry. Our ledger is a book containing the accounts to which our debits and credits are posted from the original Book of Entry. So we've used the trial balance, and we've carried over our information from our T accounts, the summarized T accounts. So we have journalized in our T accounts, kept the information in our, and we've used the trial balance to prepare and examine the information that we've documented in our journal and our ledger to make sure that it is appropriate and ready to prepare financial statements. And if it needs some adjustment, we need to go back and post and journalize, and then prepare an adjusted trial balance. So the trial balance is used to prepare and prove the equality of our debits and credits. What are the steps in the accounting cycle? Well, going back to slide 19, we saw that the steps in the accounting cycle were that we are dealing with business transactions that produce or generate source documents, which will be analyzed, and we will journalize the transactions, post the transactions, prepare an unadjusted trial balance. Perhaps after the unadjusted trial balance has been prepared, we may need to go back and make some adjustments by journalizing and posting and preparing finally a trial balance, an adjusted trial balance, which is used to generate our financial statements. And once the financial statements have been prepared and we need to close out the period, we prepare our closing entries and, as we've done together, a post-closing trial balance. What is the purpose of each of the following statements? And we've prepared these three statements together. We've prepared an income statement, a statement of retained earnings, and a balance sheet. And we saw that the income statement shows the operations, or revenues and expenses, over an operating period of time. The statement of retained earnings shows the changes to the retained earnings over a period of time. And we saw that we started with a balance of 0 and ended with $24.72 in retained earnings. And our balance sheet, finally, is a statement also known as the statement of financial position. Number 11, what is the purpose of the closing process? We saw that the closing process was a process that cleared temporary accounts to our permanent accounts and summarized those temporary accounts to retained earnings. What are the steps involved in our closing process? We saw that we had to debit our revenues, credit our expenses, and debit and credit retained earnings at the same time. We also closed out our dividend to our retained earnings and zeroed out our dividend account, our revenue account, and our expense account. That concludes the presentation, and that includes the introduction to accounting that's been provided to you by the Certified General Accountants of Ontario. And I'd like to thank you for spending this time with me, and I would also like to extend my very best wishes and very best success in your accounting studies. Thanks for attending today.